Welcome to MBA 620, Financial Decision Making. My name is Dr. Richard Works, and I will be your instructor for this course. Today's lesson will be about Project 3, Analyzing Financial Reports. This is a group project, so step 1 of this group project will be to submit your team agreement. Work with your team to complete all parts of the team agreement, including the contact information. This is a group assignment, but everyone is to submit the work individually. However, when you are working on the project, you are to work as a group. Step 2 is to compare business performance using financial statements. Here is a graphic showing the process of decision making, planning, and control. First, we start with a plan, and then actions are taken to implement this plan, which provides us with results from the plan. Then we compare our planned results with the results that we actually received and make an evaluation. At this point, we make several decisions to change the operation or revise the plans. And then it starts all over. Information for planning. Budgets for planning. There are 3 budgets that we will discuss that are used for planning. Profit budget indicates planned income. Cash flow budget indicates planned cash inflows and outflows. Production budget indicates the planned quantity of production and expected cost. Managerial versus financial accounting. In managerial accounting, the users are internal, and the accounting practices may deviate from GAAP. In managerial accounting, more detail is given to emphasis on various segments of the company, and non-monetary information is emphasized. The time focus for managerial accounting is typically future-oriented. On the other hand, with financial accounting, the users are external. These files must comply with GAAP, and they summarize information on the total company. Also, these files do not emphasize non-monetary information, and the information is basically historical. Cost, volume, price analysis. The analysis of how cost and profits change when volume changes. It is used for 3 things: planning, for example, your budget for the next year, or how much you should produce, or what would the cost and the profit be at that level. It's also used for control. For example, the production costs have increased unexpectedly this month. You want to know why. And then it is used for decision making. For example, if the price of a product is dropped or increased, what would the profit level be? So what you're doing in this profit equation is you're taking your income and you're subtracting the cost of doing business, and then you're also subtracting the cost of making your products. The break-even point will tell you the number of units that you would need to sell for your company to break even. So that would be not incurring a loss or not incurring any profit. For example, Gabby's Wedding Cakes creates elaborate wedding cakes with the following cost structure. Each cake sells for $500. The variable cost for baking these cakes is $200. The fixed cost per month is $6,000. So how many cakes would Gabby need to sell to break even? So you take the number of cakes, multiply by 500, and then you subtract the number of cakes multiplied by 200 plus 6,000, and that would be 0. The 0 is because she is not making a profit or she is not having a loss. On the other hand, how many cakes would need to be sold for her to earn $9,000? The setup will be similar to the previous formula. However, you need to add the $9,000 in as well, instead of having your profit to be 0. Margin of safety measures how close the manager's expected revenue is to the break-even level. So your margin of safety is your expected revenue minus your break-even revenue. For example, if Gabby's wedding cakes from the previous example expected to sell 35 cakes per month, what is the margin of safety? So the expected revenue would be $500 times 35. The break-even revenue is $500 times 20. So the margin of safety would be $17,500 minus $10,000, which is $7,500. Contribution margin. The incremental profit generated by selling an additional unit. Contribution margin equals the sales price per unit minus the variable cost per unit. Total contribution margin equals the contribution margin per unit times the quantity. Contribution margin ratio equals the contribution margin per unit divided by the sales price per unit. Contribution margin ratio measures the amount of incremental profit increased by an additional dollar of sales. Let's take Gabby's wedding cake for example. The unit contribution margin would be $500 minus $200 equals $300. The total contribution margin equals $300 times the quantity. Therefore, the contribution margin ratio would be the contribution margin per unit divided by the sales price per unit. The what-if analysis utilizes profit equation to determine impact of managerial decisions. First, we have the profit function that you already saw, and then we have to change the fixed and variable cost and also the selling price. Assumptions in cost volume profit analysis. 1. Costs can be separated into fixed and variable components. 2. Total fixed cost and unit variable cost do not change over the levels of interest. 3. Multi-product analysis assumes the product mix does not change. Despite these assumptions, cost volume profit analysis is useful. The purpose of cost allocation. Why do firms allocate cost? First, they allocate cost to provide information for decision making. Second, to reduce frivolous use of common resources. Third, to encourage evaluation of eternally provided services. And fourth, to calculate the full cost of products for GAAP reporting. Allocated costs serve as charges or fees for the eternal resources or services. Ideally, allocated costs should measure the opportunity costs. The purpose of cost allocation is to provide full cost information. GAAP requires full costing for external reporting purposes. Full cost information is needed when the company has an agreement whereby revenue received depends upon cost incurred. The process of cost allocation. First, we identify the cost objectives. Second, we form cost pools. Individual cost in the same cost pool is allocated using one allocation base. Third, select an allocation base to relate cost pools to the cost objective. I will pause here so you can take time to review this graphic that will help explain this process. Here is an example of cost allocation process. The University of Maryland Global Campus has X graduate programs. We want to allocate cost to these programs because we want to find out if non-profitable programs should be shut down and are the use of these resources efficient. Therefore, our cost pool would be the salaries of professors, salaries of admin staff, photocopy, computer lab, renting the building, marketing, online course pages, and information technology, things like that. The allocation base would be the number of enrollments, the number of hits per web page, things like that. The cost objective is cybersecurity, social work, and management. Allocating service department cost. First, we have organizational units of manufacturing firms classified as either production departments, which are direct, or service departments, which are indirect. Then we have cost pools, which are formed by service departments, and they are allocated to production departments. The direct method of allocating service department cost. Service department costs are allocated to production departments, but not to other service departments. I will pause here to give you time to review this graphic. Direct method. We would take Mason Furniture, for example. Allocate janitorial cost of $100,000. The allocation base is per square feet. The assembly department is 20,000 square feet. The finishing department is 30,000 square feet. So we want to calculate the allocation rate. So we have $100,000 divided by $50,000, which will be $2 per square foot. Allocation to production departments. So now we allocate this to the production departments. The assembly department has 20,000 square feet times 2, which is $40,000. And the finishing department has 30,000 square feet times 2, which is $60,000. Another allocation-based exercise. We would take Taylor Bath, 3 production departments, showers, bathtubs, vanities, and 2 service departments, mailroom, janitorial. Suggest allocation base for the mailroom cost. First, we need the number of employees, labor hours, or labor cost. Suggest allocation base for janitorial cost. We need square footage and the number of workstations. Choice of allocation base for service departments. Auburn Banking and Loan Company has 6 service departments. 1. Human Resources. 2. Duplicating. 3. Janitorial. 4. Accounting. 5. Graphic Design. 6. Food Service. These services are used by the company's 2 subsidiaries, Auburn Personal Banking and Auburn Business Banking. Please suggest allocation for allocating the service department cost to the 2 subsidiaries. Food services are used by employees in the Human Resources Department. Would a share of food service costs be allocated to Human Resources under a direct method of allocation? Now we see the items that would impact these departments. The number of employees will impact the Human Resources Department. The number of pages copied will impact the duplicating department. The amount of floor space will impact the janitorial department. The number of sales transactions will impact the accounting department. The time spent on design work will impact the graphic design department. And the number of employees will impact the food services department. Problems with cost allocation. 1. Allocations of costs that are not controllable. 2. Arbitrary allocations. 3. Allocation of fixed costs that make the fixed cost appear to be variable cost. 4. Allocations of manufacturing overhead to products using too few overhead cost pools. 5. Use of only volume-related allocation bases. Fixed costs are stated on a per-unit basis and allocated as a variable cost. Perception of cost as variable could alter decision-making. Lump sum allocations allocate predetermined amounts of fixed cost that is not affected by the level of activity. The allocation must appear to be fixed to the managers of the department that are receiving the charge. Problem of using measures of production volume to allocate overhead. These are typically allocated bases including direct labor hours and machine hours. They assume all overhead costs are proportional to production volume. When overhead cost is not proportional to the production volume, 1. High volume products are over cost, or 2. Low volume products are under cost. However, activity-based costing solves this problem. Activity-based costing identifies major activities that cause overhead costs to be incurred. Costs of resources from performing these activities are grouped into cost pools. Costs are assigned to products using a measure of activity, otherwise known as a cost driver. 1. Identify major activities. That would be processing orders, packaging, delivering, or customer service. Step 2. Group cost of activities into pools. For example, salary, vehicles, equipment, packaging materials. Step 3. Identify measures of activity, the cost drivers. So that would be the number of orders, the number of phone calls, things like that, man hours. Step 4. Relate costs to products using the cost drivers. For example, one-day service, same-day service, or standard service. The benefits of this is that it provides more accurate costing. It is less likely to undercost or overcost due to cost driver usage. It may lead to improvements in cost control as well. The costs are broken out into a number of activities rather than into 1 or 2 overhead cost pools. However, the limitations of this is that it is more costly to develop and maintain than a traditional costing system. Also, it is used to develop full cost of products, which includes fixed cost, and that lacks incremental information necessary for decision making. Compare Choice Hotels to Marriott. Marriott International operates franchises, hotels, residential, and timeshare properties. Choice Hotels, together with its subsidiaries, also operates as a hotel franchisor. Both companies have similar revenue items, marketing and reservation systems, and cost reimbursements. Neither company has inventory. Both have a large treasury stock purchase program. However, Choice Hotels has negative equity and Marriott has positive equity. Vertical analysis. The use of common size statements facilitates vertical analysis of a company's financial statements. Income statement is a percent of total revenue. The balance sheet is a percent of total assets. And the cash flow is a percent of total revenue. Income statement questions. What are the two accounts in the Choice Hotels income statement that show the biggest change over the past 3 years? What information in the 10K report helps to explain these changes? 2. What are two accounts in the Marriott income statement that show the biggest change over the past 3 years? What information in the 10K report helps explain these changes? 3. Which of the two companies has the financially stronger income statement? Explain your rationale thoroughly. Balance sheet questions. What are two accounts in the Choice Hotels balance sheet that show the biggest change over the past 2 years? What information in the 10K report helps to explain these changes? What are the two accounts in the Marriott balance sheet that show the biggest change over the past 2 years? What information in the 10K report helps explain these changes? Which of the two companies has a financially stronger balance sheet? Explain your rationale thoroughly. Statement of cash flow questions. What were the two largest cash outflows for each company over the past 3 years? Why did Marriott have a cash flow from investing activities? For a hint, see the 10K report. What are the most significant trends for both companies? Step 3 in this project will be to analyze cost and investment decisions. Costing and investing. Look at revenues, cost, and profits by type of hotel room or product. You will need to understand the concepts of activity-based costing, production cost allocation, and break-even to put together an analysis that compares costing models that account for guest room sales. Activity-based costing is an overhead allocation method that allocates cost to a product or service based on the resources used to produce that product or service. It is important to any business that has a wide range of products or services, or that has high overhead costs and where production is more complex and capital intensive because it allows the manager to allocate overhead to multiple activity cost pools. Direct and indirect costs. Direct costs are often easy to measure. For example, labor and materials. Costs are easily traced to the product or services. Indirect costs are often called overhead because they are not easy to trace back to a product or service. So what is overhead cost? Think about what activity, if any, causes the indirect cost to move. This would be payroll, billing, and purchasing. Or what about machine usage versus handmade? For that, you would have to consider electricity usage. How about Social Security and Medicare? That's based on labor hours. Fixed and variable cost. Any allocation of fixed costs is arbitrary. Fixed costs are fixed. If you stop producing one product or service, the fixed cost will remain. They do not vary with the amount produced, and they can lead to poor decision making from allocation. On the other hand, variable costs vary with the amount produced. For example, the electricity you would need for handmade items versus machine-made items. Cost allocation. The purpose of cost allocation is to link a cost or a group of costs with one or more cost objectives based on the idea that the cost objective is the cause or at least partially the cause of the cost. Step 4. Budget and forecast. Budgeting. In February 2020, A press release from Choice Hotels announced the company's fourth quarter and full year results. Using the data from this press release, create a 2020 budget and forecast. To complete the budget, use the following information. Revenues are expected to grow at a rate of 2.5% according to the full year outlook. Given the expected growth in recent investments, expenses are expected to increase by 1%. Also, income taxes are expected to be 22%. So your budget questions. Explain thoroughly how you develop your budget estimates for all revenue and operating expense accounts. Now we come to forecasting. To complete the forecast, use the following information. The low-range forecast is expected to be 2%. The mid-range forecast is expected to be 2.5%. And the high-range forecast is expected to be 3%. Forecasting questions. Which revenue category is the most important to forecast accurately? Explain your rationale for your selection and how you developed your three estimates thoroughly. Which expense category is the most important to forecast accurately? Explain thoroughly how you developed your budget estimates for all revenue and operating expense accounts. Step 5 of the project will be to discuss the strategy. Discuss the differences in the strategies related to business growth, finance, and treasury stock purchases. Discuss the similarities in the strategy. Also, discuss the strategy recommendations for Choice Hotels management. Step 6 will be to prepare your report to management. Please use the provided report template, provide a summary of the project, and be clear in your responses. Be analytical and provide supporting evidence. That will be all for this lesson. Thank you for watching.